Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about the challenging environment for bank M&A activity, which remains depressed against historical standards. And we're going to dig into what has weighed on transactions, or perhaps the lack thereof. But importantly, we have seen a few notable deals surface in the last few months, and we're also going to dig into how those deals have occurred and what catalysts could exist for more activity in 24. Coming back on the show to talk about deal making is Bill Burgess, Managing Director and Co-Head of Investment Banking in the Financial Services Group at Piper Sandler. Bill, thanks for coming on the show.
Great to be here. Thanks for having me.
Bill, maybe it makes sense to wind back the clock a little bit. We spoke last year on this topic and also giving an assessment and overview of what the current M&A environment looks like right now. It certainly looks a lot different now than it did heading into 23. Deal activity remains really slow. What's driving that? Have you seen any change there? Are discussions picking up? Where are we today?
Well, deal activity for 2023 was far less than we would have hoped at the end of 2022. So prognostications made back then were way off for reasons that we did not foresee, particularly what transpired in March. But today, the market still remains largely dormant within the bank M&A space for three reasons. And these three reasons, by the way, I think are going to persist for the next few quarters or year. And the biggest headwind right now for bank transactions is the interest rate environment and the negative marks that we're seeing for bank balance sheets, both on the securities portfolio as well as for the loan portfolio. And we can talk more about that over the coming half hour or so, because this information is public and it's going to continue to be a headwind so long as rates remain at current levels. The second encumbrance is the bank valuations, with banks largely trading at tangible book value if you add back in AOCI and valuations until they recover. And it's also tied to the rate environment. You're going to see a slow M&A environment. And I think for the larger transactions, the third piece is the regulatory environment. I think this applies for transactions where the targets are $100 billion or larger. I think for the most part, and I'm sure there's going to be an exception, but that market is almost closed down until we have a change in regulatory point of view or a change in administration in Washington, D.C. So, why are things so slow today? It's the rate environment, purchase accounting, negative impact of interest rate marks on the entire balance sheet. Bank valuations remain depressed, and the regulatory environment right now is just not conducive to large transactions.
So on the rate marks, unpacking that a little bit, we've got bank bond portfolios down 10 to 15%, give or take on average. Loan portfolios maybe down not quite as much. Is the issue with those marks that the capital hit is just too nasty to overcome? I think it was your colleague David Sandler who said to me a year or so ago that many deals are capital hungry. Is that still the biggest issue with that? Or is it more of a point to where the price you'd have to pay for it to make sense is too low to get over the finish line, or maybe a little bit of column A and column B?
The issue has to do with the negative impact of a 500-plus basis point move in market interest rates on bank balance sheets. Initially, we saw that with larger changes to AFS portfolios, and you started to see institutions with large AOCI impact on their equity. But one of the things that people forget is that banks publish their mark-to-market for their balance sheet for everything except for core deposits on a quarterly basis. And so you can see how this has changed since the end of last year. And each quarter, and this quarter is going to be worse than Q2, you can see just how detrimental the move has been, particularly for banks that have fixed rate asset portfolios and long duration portfolios. And so the median at the end of the second quarter, if you look at just the total interest rate marks, again, not counting the offset for core deposits, we're reducing tangible common equity by 42.2% was the median for the top 200 publicly traded banks. And that's going to be worse at the end of Q3, given rates have moved. So in some examples, banks have no capital on a mark-to-market basis, not less capital, not underwell capitalized, zero capital. And so it is really challenging to buy an institution that has, on a marked basis, through purchase accounting, zero capital. You will recover it. A lot of this is going to be, if not all of it, is going to be recovered through accretion to earnings per share. But at the close, if you're buying an institution that has no capital, you need to be able to fill that capital hole. And that has really been the number one reason why you've seen less transactions to date. I love hearing the stories about how people are saying, Bill, conversations are happening, people are talking, but it really can't get over math. And that's the problem that we have right now should rates stay at elevated levels. And I'm going to say, 10-year north of 4.25%, 4.5% for the next year. It's going to be pretty challenging without capital for the acquirer to solve that problem. And when we talk about what has worked this year, the answer is always they had capital, or they were able to provide capital or get third-party capital to execute a bank transaction.
Right, and one of the weird dynamics about this, or I don't know if weird's the right word, one of the unusual circumstances is not a credit issue. To your point, they will earn it back over time, but they need the capital at close. So it doesn't matter, even if it's a treasury that's sitting underwater that you're going to get back in 2 years, you have to have the capital on hand. And I think that goes to your point, absent a rate move, you're going to have these balance sheets where they are in many cases.
That's right. And right now, it feels like everything within the bank space revolves around either capital or balance sheet restructuring. Evan reminds me of movie quotes. But there's a quote from a movie, maybe you remember this one, called Fletch, where he says, come on, guys, it's so simple. Maybe you need a refresher course. It's all we meant to say was balance sheet restructurings nowadays. Everything today is revolving around bank capital. Either it's an institution that's trying to find capital to tinker with its own securities portfolio or its own balance sheet, and finding ways to improve the capital ratios. In the bank M&A world, kind of the topic of this podcast, it's how do I find the capital necessary to facilitate a transaction that I want to pursue. It could be through third-party sources. When we sold PacWest, not only did we have to find a creative structure where we marked the smaller balance sheet versus the larger balance sheet, we also had to find third-party capital. It could be in the case of Eastern, where they had in their sights a terrific franchise, but it was on our top 200 list. It was number 4 in terms of no capital on a marked basis. How do you buy an institution that has no capital? Well, we were able to sell Eastern's insurance business at 35 times earnings, book a gain, and boom, there's your ability to facilitate an M&A transaction that you find strategic. That's the third-party capital for that. In the case of the FDIC needed to find a way to sell Signature Bank and Silicon Valley Bank. And on the sell side there, we didn't have to worry about the capital because it was being provided by the FDIC fund. And that's what enabled New York Community and First Citizens to pursue those transactions. Everything requires capital. And if you're a seller that's trying to find your way through a balance sheet restructuring, either you raise capital, which no one seems to want to do, or maybe you find an acquirer with sufficient capital to restructure your balance sheet for you. And we saw that most recently with a transaction between Old National and Capstar. So everything is capital today in the M&A world, and M&A and otherwise. It's all about trying to find a way to restructure your balance sheet if you believe that these current market rates are going to persist. If you think that the Fed's going to go back to a quarter basis point and cut rates by 500 plus basis points in the next 6 months, well, then all bets are off. But no one thinks that. No one should expect that. And now everyone's trying to find a way to improve their net interest margin, to improve their profitability by either large restructurings funded with capital or smaller incremental marginal transactions to slowly improve their profitability.
And I want to unpack each of those 3 examples a bit here. I like that from Fletch. It's all ball bearings these days. It's all balance sheet restructuring. That's good. I'm lucky enough to be a participant again at your firm's balance sheet strategy seminar hosted by Scott Hildebrand. And any listeners, please keep that on your radar. It's a great one that provides bankers insight into the balance sheet. ALCO strategies, different trading opportunities, and a view of the current banking environment. But I want to pick up on that last one that was around a balance sheet strategy, the way you kind of framed your balance sheet restructuring of Old National and Capstar. Can you talk a little bit about what that looks like and whether or not we think we'll see more of those deals and how effectively it allowed a target to restructure the balance sheet, albeit through a transaction?
Sure. The short answer is going to be it depends on how large you are as a target. But as a third-party observer looking at that transaction, it looks like there was a decision at the board level of the target. In this case, this is a $3.2 billion bank in Nashville as to their near-term prospects. And the balance sheet, like most balance sheets, was going to require some restructuring. To do so might require selling common stock. It may alternatively just look at sleepwalking quarter over quarter with a 2.72% NIM that was falling, and waiting for a reduction in market interest rates. Instead, what they were able to do is restructure their balance sheet completely. And the capital that was necessary to do that was provided by the acquirer. And with that, they also received a small market premium and no longer have to concern themselves with what would happen if rates were to persist or increase. And so there's a lot of banks out there right now that would welcome the opportunity to kind of find a safe port before the storm. And by the way, we haven't even talked about the potential for a downturn in credit. But if you just take credit off the table, this rate environment is a real challenge. And so can you, if you are a $1 billion asset bank and you have an attractive franchise in terms of footprint, but less so in terms of the market of your overall balance sheet, can you find an acquirer that will basically mark your portfolio and fill in the capital hole required and maybe provide you with a premium? And so that's right now the discussion that is taking place in most major MSAs, which means if you are a bank right now with excess capital, you are in essence the one-eyed man in the land of the blind. You have the ability to pursue transactions that many others cannot because of the negative impacts of purchase accounting. So I think for Capstar, if my read is right from a distance, they found a way to restructure their balance sheet without having to dilute shareholders through an issuance and receive a small premium to market. And that's a great thing for them. But for 3 billion asset banks out there, it's a very limited universe of institutions with the excess capital necessary to execute a trade like that. And as a result, pricing is going to suffer.
Well, and the way you just laid that out, I kind of think about it on the one hand, assuming the common was there, it's probably going to come, one, valuations are not great today. So if you want an independent entity, it's going to be expensive, but it might even be at a discount, right? And versus a market premium. So effectively, you're looking at the one hand of the cost of issuance on yourself and what kind of certainty would you have there, and potentially massive dilution where you can actually look at the premium relative to today. So, I mean, the spread between those two things, maybe I'm oversimplifying it, but if that's the route you're going to go, that spread's probably considerably wide, even though the deal price might not look that high relative to where we are over a long time period. I don't know if that's the right way to think about it or not.
It is, although we have no ability to compare the equity issuance component of it, because the one thing that we have not seen in 2023 is capital issuances by banks. And I don't mean just common equity, of which has been close to zero, but also on the subordinated debt side. We have not seen a single community bank issue a Kroll-rated only sub-debt offering in 2023. And that was gangbusters in 2021 and parts of 2022. So if you think you need to raise capital and you want to raise capital to restructure your securities portfolio or maybe your loan portfolio, no banks are doing that right now. And I think everyone's afraid of kind of being the first mover. We have a conference that starts this week in Florida, and we have an equity capital markets team down there. And their biggest question is, at what point will banks start to tap third-party capital, either institutional capital or private equity capital, to kind of prepare themselves for a rate environment that may persist? But it's amazing how I agree with your analogy that you could raise capital at a discount, you could sell at a small premium, and that's kind of the bid-ask spread. The problem is there's no bid, and there's fewer asks given that there's so a few banks out there with the capital to put to work.
Well, and the other way we've seen that you mentioned of banks effectively unlock capital or raise capital, the case of Eastern, and they're not alone, selling their insurance brokerage units. We've seen a number of them do that this year. We put out something recently talking about how the number of banks selling has exceeded the number of bank acquisitions, which isn't surprising given where valuations are, but the first time, 8 years. So you're seeing banks sort of flip there. Do you expect to see more of those, or do you think that there are other sort of non-bank entities, businesses that they could look to trade? I mean, I don't know that we're necessarily looking for asset generators right now, but more of those, more other options for institutions to do that to facilitate loss trades either in the bond portfolio or loan portfolio?
So in a world where capital is king, banks are constantly trying to find new ways to improve their capital ratios, either through reducing the denominator through capital relief trades or the sale of portfolios of assets, or improving the denominator by finding assets that they can sell. They could sell their Visa B shares. They could sell branches. They could sell geographies. Or they could sell businesses. And the vogue business to sell right now is insurance brokerage. And at 35 times earnings and 10 to 11 times EBITDA, I can understand why. And that has been a big part of our business to date, having sold M&Ts and Easterns and most recently Evans Bank. But the reason for doing it differs. In the case of Cadence, they just sold theirs. They're going to restructure their balance sheet, pay off wholesale borrowings, and in the short term, shareholders love that. The stock price was up. Now, what you do with that capital is going to be case dependent. And again, for Eastern, it made perfect sense to roll that into an acquisition that was going to require a unique amount of capital in the short term, given the balance sheet nature of Cambridge, but will certainly pay off over a number of years, both through the accretion of the interest rate mark into earnings, but even more importantly, just creating a better franchise for Eastern and Boston. So I do think that if you have something that you can sell that is 9 times what you are trading today, it is certainly going to be an attractive consideration, and it'll be additive to your earnings per share. But what you do with it, I think, also matters. And it's amazing to me how investors today are kind of more short-term focused. They may say, buy back stock, which is, I guess, fair. But you really, long-term strategies are not surrounded by buying back stock alone. So I think you're going to have to balance what you want to do in the short term and the long term if you're a management team and you have the ability to kind of capture a gain like that. Many private companies will opt to keep that business because they view it as a long-term component of their underlying commercial lending business.
Sure. And I've heard some of the investment community, to your point, who try to take a longer-term view, question, are you selling a good earnings stream over a longer term based on a short-term issue? But you just laid out a case where you're improving the strategic value of the franchise, right? Because it's facilitating not just even something financial, but in the case of Eastern there, you're changing the franchise through the acquisition. So to your point about case dependent, you got to look at it on the face of what are you going to do with it beyond just, okay, I've got an opportunity to cash out at a high bid.
Right.
So you mentioned, too, the Bank of California PacWest trade, and one of the things that we've heard more of and actually talked about on this show is the idea that you got more PE firms kicking the tires on banks, which is not surprising with valuations where they are. You have people coming out of the woodwork looking for opportunity to take advantage of that. And as you say, capital's king. You need outside capital to facilitate these trades. Have you seen more firms kicking the tires on banks looking to do those kind of deals where they recapitalize a pro forma institution? And if so, what helps facilitate more of those? What's the roadblock to those deals if there are more people showing up looking to provide capital?
And I think this is a case where conversations are happening, actually could lead to more announced transactions versus just, people are talking about bank M&A. Because I think the math can be compelling for third-party capital in an M&A construct. And look, I grew up at Sandler O'Neill in 2010 and 11 when we were trying to recapitalize institutions, and you had no real idea what the amount of capital required was. You'd look over the edge of the loan portfolio, you throw a nickel, and you'd wait for it to hit the bottom, and it may not. Here, when we're trying to fill a capital hole that is sourced from interest rate marks, particularly if it's a bond portfolio or treasury portfolio. I mean, you know exactly what the size of the hole is and how you're going to recover it. So the amount of risk associated with filling a capital hole in an M&A deal for interest rate marks is dramatically different than credit marks. And so if I'm a private equity firm, I love this. This is wonderful. I don't have to kind of bet the ranch that commercial real estate is going to have a better loss given default than I had modeled, or I'd relied upon a third-party loan firm to assess what could go right, what could go wrong. So I do think that there's a lot of interest for private equity to partner with institutions. And by the way, I think it's beyond that. I think if there are transactions with two public companies, you could wall cross investors that are already in a stock and allow them to participate as well. And in some ways, I like them better. Their return thresholds are lower than private equity, which is, despite the lower risk, going to want the same return, by the way. But I also want to reward shareholders who have been into a stock for 1 year, 5 years, 10 years. One of the lessons we heard from the PacWest deal is that while I think in hindsight it was the right thing to do, and I think that the size of the private equity check required some big names and some rapid movement, it is quite possible that you could have talked to some of the shareholders who have been in PacWest for a decade, and they could have been wall-crossed and understood the transaction structure and contributed capital as well. So, and this is one of those things where, in hindsight, you can kind of second-guess things. But going forward, I think that if the only reason not to do a transaction is because it's going to be a temporary hit to capital for interest rate mark, there are a plethora of capital providers, and we're trying to be more creative in tapping those capital providers to facilitate transactions that make otherwise real sense.
Yeah, and in closing, if you could just expand a little bit on that, I think that's really interesting. You know, the idea, and I've had this conversation with a few bankers, that yes, this is tough right now, but there's that old line, if you have money when nobody else has money, that's the best way to make money in this business. And it feels like we're shaping up for that. And I don't mean that broadly, everybody in trouble, but there's going to be real opportunities here. So if you can build that war chest, so to speak, and you are relatively clean, there's going to be real opportunities. How do you go about doing that? You know, what would you say to our bankers other than, you know, we call you up, of course, and you're going to help them facilitate that. But what does that process look like? You know, how do you look to form that? If you say, maybe I don't need it tomorrow, but I know that there's going to be people calling me in 3, 6, 9 months, and I want to be ready to go. And I want my existing shareholders to participate in that transaction.
So if I were an acquirer and I was looking at the landscape of targets and felt like I would need to raise a significant amount of capital to facilitate transactions, I would be looking first internally to see what I have on my balance sheet that I could turn into a capital gain and deploy in a transaction. Do I have an insurance brokerage business? Do I have Visa B shares? Do I have a geography I don't care about that I could sell, reduce my balance sheet, and add a gain? I would want to know what shareholders that are in my stock today, if I were publicly traded, are so enthusiastic about our story and confident in the leadership that they would further invest to support a transaction. And then lastly, I'd want to have conversations with third-party capital providers, but I would be fairly standoffish about that because you want to make sure that you kind of know how it works, what the timetable is, the return thresholds are, but you don't walk down that path until you have something that is far more concrete. I mean, the best example I can think about where third-party capital came in very quickly, and I think it's applicable going forward here, is years ago we helped a bank called MB Financial raise capital over a weekend when they had bought through an FDIC-assisted deal a bank called Chorus, which was like $7 billion of assets. They were going to shrink that balance sheet pretty quickly, but leverage ratios don't care about how fast you can shrink. And so over the weekend, we wall-crossed about 10 investors, and we were able to raise a couple $100 million in common equity come Monday morning. So between Friday's market close and Monday morning, they needed $200 million of equity, and we got that. And I think that was a testimony to the management team's credibility, both with the marketplace and their investors. And it wasn't hard because they had the right transaction to kind of market it off of. So I think all kinds of capital available for the right transaction. If you can do it by selling things that aren't nailed down, that have an embedded gain, that's something to consider. But if it means third-party capital, you have to consider both your existing shareholder base as well as outside providers. And at a time like this, when there's a lull in the marketplace for bank M&A overall, why not use this time to ascertain your alternatives and make sure that if and when the opportunity comes, when you hear the knock at the door or the phone rings, that you've got a game plan in place to support a transaction that years from now you'll look back and say that if not for that action, you wouldn't have the franchise that you do then.
Well, terrific. I think that's a great place to leave it. Love that example, too. That was a sizable, important deal that I remember that definitely was a good trade for them. So, Bill, thank you for that, and thanks for coming on the show. Definitely appreciate it.
My pleasure.